All right, good morning and welcome back to the Money Advantage podcast. This is Rachel Marshall and Bruce Wayner. Today we're here for a great conversation with you on life insurance from the beneficiary's perspective, looking through the beneficiary's lens. And this is something that I think is going to be an enlightening conversation for all of us, especially those of us who are interested in using infinite banking, using life insurance as a place to store cash, and we're thinking about all of the advantages of being able to have control and access to capital. We're also thinking about the death benefit that will eventually pay into the the hands of our beneficiary, whether that's directly to them or into a trust. Yet we're still thinking from our perspective. And this conversation really was inspired by a question that we had, Bruce, last time you and I were on one of the podcasts that we were talking about infinite banking. And we had a question about the beneficiary, which really sparked this whole idea of looking at life insurance from the beneficiary's lens. What it does for them, what it feels like for them, what are the advantages for them, what are the rights and privileges for them, what does life insurance look like from that angle. And so today I'm really excited to dive into this conversation. And Bruce, I know you've been doing this a long time. Just really excited to have this conversation today with you.
Yeah, I have been doing this a long time, and luckily, I've only had to, I guess luckily is the right word. I've only had to deliver three, actually death checks, um, for for the death benefit, and it's a really humbling experience, but it's also a proud moment because you're helping people in their time of need, and oftentimes, none of them happen to me, but I've heard other agents say that oftentimes people actually even forget that they have a death benefit.
Mm.
So that is another thing I think people need to have the conversation with their loved ones is that, where are we with our death benefit? And knowing that because a lot of death benefits actually go unclaimed. Uh,
What? Are you
oh yeah,
serious? That's, I had no idea. That's a surprise to me.
it's billions of dollars of death benefits being held by insurance companies that are unclaimed. Uh,
Wow.
and it's a little better now, but back then the ability to get the death benefit, and then there's been some regulations that actually have been trying to improve this so that insurance companies would continue to look for the people instead of
Mhm.
put it on the beneficiaries to find the money. Um, and so what insurance companies are like any other business, they would like to have your business. So they will hold the money at the insurance company and you will earn interest there. And they will actually send you a letter and say, you can actually keep the money with us and then you can just take it whenever you would like. And it's earning X amount of interest at this time. And
Wow.
some people choose that. I've actually had a client that has that, not from one of the policies that we set up from, but from a previous policy that her husband passed. And she just leaves at the insurance company and she says, well, I'm getting 4% interest. Why would I move it? And so we've left it at the insurance company and she gets the interest payment from it all the time. Most people, though, like to take it in their control and invest it or pay down debt or they um, give gifts to their children, adult children, or however they want to do it to leave the legacy. So
Mm.
there's a variety of way that beneficiaries can benefit, but there's things that people need to know, and one of the big thing is to talk about, you know, how much life insurance you have and how much life insurance the spouse has coming to you. Now, some people never know because it's like an old aunt that left them that didn't have a lot of beneficiaries, so they left it to a nephew or a niece, or they didn't, the beneficiary, we're going to talk about this, I know today, the beneficiary passed away. So now it has to go into the court systems and they have to distribute it according to the court systems. So they decide where it goes.
That is so, so fascinating. Honestly, Bruce, part of what you said, I just had no idea on. I had no idea on multiple of those pieces. So I think what's really interesting, and Bruce, we've said this so many times on different shows, but for somebody who's maybe not as familiar with life insurance, what's really important to know is that you have three people or three players in a life insurance contract. And so you have the owner, the person who decides to get the policy, they decide to pay for the policy. Well, I guess anyone can pay for it, but they own the policy and they're the ones who have the ability to change the other players. Bruce, maybe I should let you talk because I don't want to misspeak here. You've got the owner.
Right.
They, in a cash value policy with whole life or any other policy that builds cash value, the owner is the one who has the right to access the cash value. So that's the owner. Then you have the insured. This is the person whose life has gone through underwriting. The policy is on their life, and that person is the key player in terms of while they're living, the policy stays in force if it's a whole life policy, and when they pass, the death benefit is paid out. We can talk about term insurance around this whole idea as well, because there's some differences there. But then you have the beneficiary, and that is the person who is receiving the benefits of this policy. If it's in force, if a life insurance policy is in force, when the insured passes away, the beneficiary receives the death benefit payout. This is true for term life insurance, for universal life, for indexed universal life, for variable all of the insurances, and especially whole life insurance, which we do most of our work with. So the beneficiary is this person or entity, we'll talk about that again in a minute, that is going to receive a payout when the insured passes away. Bruce, anything you want to clarify? I probably caused some confusion around some of that.
Oh, no, I thought that was there's just a couple things to add is that there's three parts, as you said, the owner, the insured, and the beneficiary. The owner is the only one that can actually change the beneficiary. The owner can actually change the ownership to someone else if they would like. The only part that cannot be changed is the insured. And so the owner drives the situation, and the owner has to have an insurable interest in to take out the policy on that particular insured person. But what's interesting is once it's in place, the owner is the owner, and they can decide to make changes, including ownership. So they can put the ownership with someone else. But the beneficiary can be changed also. And that actually happens a lot, depending on whether a person is using an individual, or then they may actually change it to a trust later on. Uh, Changing it to the trust has some benefits. The benefits are that now the trust will dictate how much, if any of that, is going to be paid out right away, or it can be paid out in steps according to the trust. The trust may say something like um, the beneficiaries of the trust now. Let's not get confused, because the trust is the beneficiary of the life insurance, and then the beneficiary of the trust, it will say something like, um, we're going to distribute 50% right away from the death benefit, and then we're going to distribute it at another 10% of it for the next 10 years, starting at age 36 or at age 40, however the person that set up the trust wanted to do it. Or they can put even more contingencies on it and say, and this is one of the things we talk about for generational wealth, is that it's going into the trust. The trust is the beneficiary, and the trust is then going to purchase life insurance on the next generation, and they are going to become the insured. The trust is going to become the owner, and then the beneficiary can be then set up again to be the trust again, to continue feeding the trust and building wealth.
Which is how, I'm just going to be honest, that's how we have our setup. When Lucas and I first got our life insurance policies, we didn't have the trust in place. And so we had beneficiaries listed otherwise. Then we established our trust and we made the trust the owner, or sorry, we made the trust the beneficiary of our life insurance policies. Then we wrote a memorandum of trust, which is not legally binding, but it's guidance that directs the way that we would have our trust in the future intended to be used. And one of those intents is to have the trust purchase life insurance on consecutive generations. So we've placed in that guidance knowing that they might not follow it, but we're teaching and training our children to understand the value of life insurance. And then we are paying premiums now for a death benefit that will deposit into the trust. And at the time that the death benefit is paid out, we've talked about it being leveraged up death benefit. It's always more than you've paid in premiums. And because of that, you have now a greater pool of capital to be able to use as the funding source for additional life insurance policies, which if you can continue this going on for multiple generations, you have a long-term compound interest building wealth generation tool that can last for generations.
Yeah. And the great thing is it's self-sustaining, so it'll just continue to go up. The beneficiary, which is the trust, can also have, you know, statements in there that say, you know, you can have X amount of the cash value, as long as you put together maybe a business plan, or some people say that, you know, you can use it for an investment, but if the investment does well, then it has to go back into the trust, and you can keep a percentage of it. So there's all kinds of things you can do with the memorandum of trust to to make sure that the beneficiaries are using the beneficiaries of the benefit of the death benefit into the trust the way that you and your spouse or you intended it to be.
Mm-hmm.
But really, it's a very simple process if you set it up and up front. And if you do it as an irrevocable trust, then you can change the process. You can obviously change the memorandum of trust also while you're still living. So it's a really simple process if you understand it, that the beneficiary is simply going to get the death benefit from the insurance company, and that could be a trust getting it, or it could be an individual getting it, or it could be multiple individuals getting it. We have all of
Yes.
our life insurance going to our trust, and then the trust, we have multiple individuals. I think if I count them up in my head right now, I think we have one, two, three, four. We have five beneficiaries of our trust. My wife and I, we don't have any children, so it's God children, it's nieces and nephews that are getting it. So, and it's all spelled out how they can use it and so on and so forth.
I like that you mentioned multiple because it's important to know that you can have multiple beneficiaries of your trust at the trust level. You can also have multiple beneficiaries directly of your life insurance policy. So, without a trust, and you may not find the advantage in doing this, but you can have you be the owner of your policy on yourself, with you being also the insured. Um, and you then you could specify 25% to each of your four children at the time of your death. And those would be, I don't know what you call them, but they're all equal beneficiaries. You can also list a contingent beneficiary. Is that correct, Bruce?
Correct.
Can you
You
explain how
can
that works?
you can list multiple contingent beneficiaries. So when you set it up, you're asked who the beneficiary is. Let's pretend right now it's not a trust. Let's just say it's going to be individuals. And so you can say, in our case, we have five, so we can simply say 20% to each one of them. It doesn't have to be equal. You could say 50% to this person and then divide the rest up for the other four people. You can even add entities to it. So you can say this charity is going to get so much. But then you can also set up a contingent beneficiary or multiple contingent beneficiaries in case the primary beneficiaries have passed. Now, this is one of the great examples of why trust actually can be more beneficial, because you can
Absolutely.
language in there that says you would like to, and we have people do it a variety of ways. I'm just going to use examples because I think examples are a lot easier for people to understand. So we have a client that has a trust, and they have three children that are the beneficiary of the trust, and each child is going to benefit from a third of the trust. If one of those children passes away the the before the the parents pass away to fund a trust, then in that particular trust, because they have grandchildren with each child, it's still going to go to that family and going to flow down to the grandchildren. So that in that case, they have it set up in a trust that the contingent beneficiaries for that side will actually be the grandchildren for that third. We have other people though that say, no, they're not married, or even if they are married, they don't have any grandchildren and they don't want it to go to the daughter-in-law, let's say. So then you can actually set it up in the trust to say it was going to be a third, a third, a third, but if any one of them have passed, then we're just going to take the remaining and go 50%, 50% for the last two. So you can change that according to if the primary beneficiary has actually died. That doesn't happen very often.
I
And
think it's, go ahead, Bruce.
if you don't have a contingent beneficiary named, then you do have an estate plan. If you don't have a trust, that estate plan is called the state in which you live in, and it's called probate. And probate will decide the order of where your assets go from the death benefits.
Which may or may not be what you would have desired
Right.
or what you would have even thought would be the most logical path.
Correct. Correct.
So there's a lot that we've just said. And I think, Bruce, the most important thing is back to the original statement you made is to make sure you're communicating about this, especially if you are the generation that I call Generation One. You have the Generation One mindset. You're the wealth creator. You're the one setting this up for future generations. You're in a position of not just wanting to do the right thing and take the steps that are often, as you've said, often the hardest to get the ball rolling, to begin thinking a different way, to think about utilizing life insurance as a place to store cash, as this cash management system. And if you are in the position of doing infinite banking in that way, don't keep the secret to yourself. Make sure that you're communicating to your children and grandchildren or to any heirs that would be listed as beneficiaries so that they're aware of not just what they'll ultimately receive. I think sometimes there can be this concern about telling the next generation what they might receive. And the reason for that is that they think, well, my kids or grandkids or whatever are going to get greedy, or they're going to think I'm worth more dead than alive. There's all these negative connotations that come with communicating about that. Or they don't want the rivalry to begin before they've even passed and the death benefit is ready to pass on to the next generation. But the challenge is that you don't just want to tell them what there is in store, but tell them why you placed it in place, in force in the first place, what your vision was for that, what you're hoping that they'll do with it. Because as you not only make powerful financial decisions for yourself, you have the ability to communicate that vision to the future so that it can truly bless and benefit them. And actually, one thing that I wrote about in my book, Seven Generations Legacy, I don't think I have a copy right
On your
readily
shelf.
on the shelf behind me. Oh, here, this way. One thing that we talked about is writing a love letter to your kids. And this was something really profound that Lucas and I came across this idea as we had the life insurance in place and as we were thinking about the potential for having wealth passed to our kids. We wanted to make sure that we communicated that the purpose of all of that was our love for them. And I think sometimes that's the piece that gets missed. If you are using infinite banking and you're setting up this cash management system, you might be doing it for the purpose of the living benefits primarily that you have access to use and have during your lifetime. But there's such a generational component and this long-term thinking that you have when you set up a life insurance policy, especially a whole life policy that is permanent and guaranteed throughout your lifetime, that will pay out a death benefit. And the truth is, I don't know about you, Bruce, but from my perspective and from what I've heard people say, the people who set up life insurance care about their kids. They care about something. They care about some cause. They care about the ability to impact financially something outside of themselves.
Yeah, I would say that that's one of the big detriments that I see that people who want to implement infinite banking is they say, I don't care about the death benefit. And Nelson And I've actually had people prove that to me or try to prove it to me by quoting Nelson in his book that said, and when Nelson made the statement that your need for financing is much more important than your need for death benefit. And what he was saying was, so people are twisting that around and say, see, Nelson said you don't need much death benefit. That's not what Nelson said. Nelson says your need for it while you're still alive is more important for financing than it is for death benefit. Nelson thought death benefit was very, very important. And frankly, we think death benefit is very, very important because the death benefit, the amount of death benefit actually drives the dividend that you get. And the dividend is kind of like the protective railings on policies. And I can't get this across to people more and more because people are being hurt by agents that are not concentrating on death benefit.
Mm.
And they're doing it from a holier than thou attitude, like, oh, look, we drive down the death benefit so that you don't have to pay as much in mortality costs. Thus, you get more cash value. But what they don't tell them is that actually puts the risk much more onto you to keep the policy going. We had a client, a Money Advantage client, just yesterday, who he has a policy, and his son-in-law has a policy, and they're trying to do this generational wealth building. It's really neat. They have a trust. The trust is the beneficiary of both the death benefits, and they're purchasing real estate with it, and it's going into the trust, and it's a really nice system. But I was talking to the father-in-law who's 62, and he's talking to his son-in-law who's only 32, and he said, I'm trying to get my son-in-law to understand that death benefit is important.
Mm.
He said, and I told him I didn't think death benefit was important either when I was 32. But every year that passes now, he said, I see how the death benefit is more and more important. And he's approaching it from his son-in-law telling him, listen, I know I'm trying to help my daughter, who's his wife, and his other kids actually have a leg up and build a wealth legacy for them. The best way he can do it, he told him, without taking risk, is to have a leveraged up death benefit. And we talk about this all the time. The first generation is the most difficult because they're the ones that are building the wealth. They're the ones that are the progressive thinkers, the long-term thinkers, not the short-term thinkers.
Mm-hmm.
And they are the ones then are going to use a portion of their assets to purchase life insurance. That life insurance is going to provide a leveraged up death benefit. And even if their real estate holdings go bad, even if their other investments go bad, upon his death, that trust will be the beneficiary of a large death benefit that will get passed along to the next generation.
You know, Bruce, there's so much that you said in there. If someone is not as familiar, Nelson, as we're referring to, is Nelson Nash, who wrote the book Becoming Your Own Banker. I had the privilege to meet through Bruce. Bruce was mentored directly by him. He was what you could call the father of infinite banking. He coined the term, the infinite banking concept. He had the wisdom and foresight to understand that when you have a whole life insurance policy, you have cash value that you can personally tap into by using a loan. And that if you understand the value of holding and preserving capital, you'll want to put as much of your money as possible into this cash management system that provides so much benefit for you in your lifetime and for generations to come. And I don't know if I'm quoting an exact line in the book, but basically that whole statement around you have a greater need for financing than you have for death benefit. I believe he also then said, if you solve the need for financing, you will automatically solve the death benefit need in your life. I don't know if I'm misquoting him. I hope I'm not misquoting, but that was the idea that he put into the pages of his book.
Yeah, what's interesting is, and we have a couple questions I want to answer here in a second, but what's interesting is that if you go through a needs analysis, which I actually hate our industry that does a needs analysis, I actually want to have a want analysis. What do you want
Yes.
rather than what do you need to happen? Um, we had a a potential client the other day just tell us, well, I don't need that much because if I die, my wife would just get a job. And I thought, is that really the way you want your family to run? Is you have three children, you die, yes, you have some death benefit coming, but now you're telling your wife, well, you're just gonna have to get a job. So that's right. She doesn't need that much, but wouldn't you want her to have more? So one, maybe she does get a job, but does she have to feel the pressure to go get a job at a certain level, a time commitment that she doesn't have to, can't take care of the children the way you want? So that is if you solve financing though, and you get that money stopped flowing away from you, you don't need as much death benefit because you don't have as much financing flowing out of your control. So that's another thing to consider is if you have your house paid off, if you don't have car payments, if you don't have credit card payments, you don't have a lot of your cash flow going to those payments. So then if the breadwinner dies or one of the breadwinners dies, then you don't need a biggest pot of pool because you're not having to pay all those extra financing costs.
Mm-hmm.
So Nelson was 100% right that financing while you're living is more important than your need for death benefit. So let's address this. Fritz, a great longtime listener, he says, if your beneficiary dies before you, how are these processes handled differently and the timing of such? So hopefully, if you're working with us, we would have a contingent beneficiary. So nothing would have to be done, Fritz. Um, you don't even have to then change and say it's the primary beneficiary. You may, though, want to do that and add another contingent beneficiary onto the process. It's a very easy process. It's just paperwork. If you do not, Fritz, if your beneficiary dies before you and you do not have a contingent beneficiary, then it's going to go through probate. And that in the United States, in most states, is it expensive. Anywhere between 3 and 8% of the estate will actually get paid for lawyers by law, even if they're not doing a whole lot. And they really don't do a whole lot because the state has their statutes that say this is where the money's going. So you're automatically going to get your estate whittled down between 3 and 8%. So if you have $1 million estate, it would be anywhere between $30,000 and $80,000 that would go to an attorney for not doing a whole lot. Contrast that with, let's say you even want to put your trust as the contingent. Well, if the primary beneficiary dies, it goes to the trust, and it misses probate completely, and you don't lose out on that $30,000 to $80,000. Now you do have to spend the money for the trust, and depending on where you are and how much you need to do with trust, it can be anywhere between $3,000 and $10,000
Mm-hmm.
for that trust to set it up. But between 3 and 10,000 is a lot less than between 30 and 80,000. I just had this conversation last night, and I did the same thing. This client actually said, we actually paid for my mother and father to set up their trust. I did the same thing with my mother and father. I paid to have my mother and father's trust set up for a couple of reasons. One, I did not want at the time of their death to be any questions between me and my three sisters, even though we have a great relationship, because money makes things funny. Money makes things funny. And our state attorney says at the time of death, in-laws or my brother-in-laws could potentially become outlaws because they're trying to protect their spouse and saying, why are you letting your sister do this? Why are you letting your brother do this? Well, if you have it all set up in a trust, you can in a court can actually say, this is the way the the person wanted it to be done. It can't be fought.
Mm-hmm.
So Fritz, that is the thing to consider. Now, Joey says, Is it expensive upfront to set up a trust? Well, I just addressed that. Who can be the trustee? The trustee can actually be anybody that sets up the trust wants it to be, including a trust company. Joey, interestingly enough, I'm meeting with a trustee company tomorrow to actually get the fees, getting the procedures to become the trustee of a special needs trust for one of our clients. So they can actually continue in case any of the trustees actually, they did not want their daughter to be the trustee of their son special needs trust because they didn't want to put the pressure on her to actually carry out the fiduciary needs of the trust. Because even if the daughter could say, well, this is what it says in the trust, they thought it was going to drive a wedge between the daughter and the son potentially. So they're going to go with a trust company. So Joey, you can actually use
Go
a
ahead.
trust company. Go ahead.
I was going to add on to that. If you are setting up an estate plan and you are selecting a trustee, you want to have that person be somebody that you trust to make decisions on your behalf, to understand your wishes, to understand your financial philosophy. And you can often, and you should consider listing not just a trustee if you're listing a person, but listing a contingent trustee. So we've talked about contingent beneficiaries, but a contingent trustee would be somebody who can step in and act as trustee if that primary or main listed trustee is either no longer available or no longer willing at the time of needing to facilitate the trust. You can also have a board of trustees that has to make decisions together. You can have an institutional trustee, as Bruce is talking about, who is often a legal entity. So it might be a lawyer or a law firm, a bank. So there's a lot of different options that you can use for having somebody be trustees. Some people want their children to be trustees, or some decision-making power of a board that is formed up of who's voted in to stand in a position of decision-making capacity as a board of trustees. So again, a lot of options there.
Now, I actually have three. I have my trustee, and then I have two contingents after that. And then the trustee can actually choose, according to our language, they can choose to change the trustee to a trust company if they choose, because they don't want to do it anymore. And they understand that there is a cost to that. So the trust will pay that particular cost. It's another thing that I encourage our clients to do, is if they have a trustee like a child who's doing this to represent their children. So I'll just use myself as an example. I'm the trustee of my parents' trust, and I have three sisters. And I always often encourage, because I know how much work it is when a person dies, to be the executor of the trust. The trustee is the executor of the trust to make sure it happens, it gets distributed, or has ongoing distributions. It's a lot of work. There's a lot of communication. So I often encourage them to have the trustee actually get paid from the trust an additional amount every year. You can make it a flat amount, you can make it a percentage of the trust, so that, yes, it's still going to be a lot of work, but at least they feel, because some people have to take off work. If they're business owners, they have to spend some time away from the business. So they ought to get compensated for that. All right. Joey says, is it expensive? I think I already addressed that, Joey. Who can be the trustee? Well, I think we addressed that. Anybody that you choose, but like Rachel says, it's the reason they call it a trustee. It's somebody you really need to trust. I have thought, in Joyce's, I've thought about changing my beneficiary to the trust in order to give a better framework for using the death benefit. Joy, I think that's a great idea to do. And then he comes back and says, for my family, if I were to pass away early, first generation here, and still living on low means, so an influx of cash could be hard to handle for my spouse and my children. Boy, Joey, we were just talking about this just yesterday, with another advisor in our office. He was saying that one of their clients actually got an influx of cash from his father who died. And he decided now he did not need to work anymore because he had this big pile of cash. He said, but now he's not working. He has all this extra time and he's just blowing through the cash. He's just calling them. And he said the advisor I was talking to said he was going to have a real hard conversation with him to say, hey, um, this is what your father did. He left this to you. I don't think he intended it for you to just use it frivolously, and you're almost out of the money. Um, and he said this particular advisor said that he feels like he's going to be blamed for not making the money last longer. And I agree. People are blinded by their own behavior. And so he's going to tell the person just to take his business somewhere else.
Mm.
And so, Joey, you're absolutely right. Money does weird things to people. So the trust can actually outline it. And most people actually um, do the distributions with a triggering event. They will say, hey, we're gonna do a distribution at 35, at 40, at 45, at 50, at 55. Or we have some clients that's like you said, Joey, and how this person stopped working. They will say you have to bring your W-2 or your tax return in to the trustee, and whatever you made that year, we will equal that as a distribution from the trust.
Mm-hmm.
So it actually has a person saying you can get a distribution from the trust because the trust language says only after you show us how much money you made this year. So
Bruce,
people are
go ahead.
responsible.
I think you're speaking to, and Joey, thank you for your question. For some reason, I'm not seeing them in my feed today. So thank you, Bruce, for sharing those questions. I think, Joey, you're really hitting on the main pain point that most people have around estate planning, which is really what we address through Seven Generations Legacy Coaching. And I don't talk about this very often on the podcast, but I think it's relevant to mention here specifically because there can be a lot of concern, and rightfully so, with cash that is dumped on unsuspecting, unprepared heirs that don't have the tools and the understanding and the knowledge of how to steward that. And so I'm a fan personally of having money held in trust and then directing how that money is able to be accessed rather than just having outright distributions or even rather than having a triggering event with a time frame or having any dividends at all. I'm more a fan of saying, we want to use this capital for specific reasons. And if you do that, you can specify that somebody could access the capital if they were to purchase a home, or they could access capital if they wanted to make an investment or start a business. Maybe they would need a business plan in place first. You have a lot of ability to direct and write down your wishes in a memorandum of trust. It's also called a memorandum of wishes. Some people call it an ethical will, but to direct, let me reframe that word, to inform the trustee and the beneficiaries how you would desire your capital to be used after your passing, especially capital that is held in trust. And the reason I say inform of your desires is that it's not a hard requirement because a memorandum or an ethical will is not legally binding, but it's guidance that communicates the desire and the intent of the person who set up this whole system in the first place, which is what we've done personally in our life and we're helping clients to do. And it's really powerful to be able to understand that you have a lot of capability as the person who's setting this all up for future generations to be able to communicate effectively. And that comes right back to, Bruce, your initial point about communicating to your heirs what is available and what you desire them to do with it, because you can fund lavish spending or you can fund industry and stewardship and business creation and wealth creation. You can fund either depending on how you communicate about the wealth that's left behind.
Yeah. So just to let you know, Fritz was asking about this because his mother passed last Saturday, and I give
Oh,
him
I'm sorry to hear that.
sympathy for that because Fritz has been a long time supporter of the podcast, and we appreciate it. And so Fritz has wanted to know what he needs to do now. So if you didn't have a contingent beneficiary, then you just need to either contact the company that directly, or your agent should be doing this kind of customer service for you, and they can get a new form so you can change your beneficiary. Another question Joey comes up here with. He says his wife is disabled and unable to work, so it would be a hard stretch out. What I have as a current death benefit over possibly 50 years. We're under 40. Kids are 9 and 13. My wife is. Oh, I see, Joey. You're saying it'd be hard for her to stretch out the current death benefit that you have for your because you're under 40 and the kids are 9 to 13. So, Joey, what I would suggest you do, we don't know your situation, and if you'd like to get on our calendar, I'd love to talk to you about your specifics, but um, it is hard to get the amount of death benefit as a young person that you might need to protect your family only using whole life insurance. So what you could do is get some more term insurance on you. If you're under 40, you could get $1 million for less than $100 a month, um, depending on how long,
Well
how,
worth it.
yeah. And so that would could alleviate some of your concerns since you have kids are 9 through 13. And then obviously as they get older, the term could then be converted because you don't have as many expenses with the children to a permanent policy, or you just let it lapse if you don't have the needs or wants at that time. But
Mhm.
I would encourage you to look at some term coverage that will then help you at this times maybe for the next 20 years, because in the next 20 years your 9-year-old will be 29. And yes, you may want to still set them up generational planning wise, but this would be the best way to protect it from an income perspective right now is to supplement with some term insurance. So if you want to get on our calendar sometime, I did put my email in the chat. If you look up Joey earlier talking to Fritz, you could email me directly and we could set something up.
And Bruce, I'm just going to add and affirm what you just said. So my husband and I'm 40. He's around that 46, I think. Our kids are young and we have as much whole life insurance as we can, but in addition to that, we also have as much term insurance as we can get. And so I'm a huge fan of maximizing what is called your human life value or human life economic value. And this term seems um, challenging a bit because there is no human life is infinitely valuable, right? And there's not somebody who's worth more than someone else. But from the insurance company's perspective, they will insure you up until your human life value. What that means is basically the economic replacement value. If you were to pass away, they take an algorithm based on your income and your age and your assets, and they look at the big picture and they say, if this person were to die today, what is the income earning potential that they have over the rest of their income earning years that would then be lost to their family if they were to die early? And I think that's a really helpful perspective because it's not as simple as just saying, well, how much does my wife need to pay off the home? That's needs analysis focused. But if you look over at what you want to create, chances are what you want to create is the best possible life for your spouse and your children regardless of circumstances, whether you're here or whether you're not here. If you're here, you are going to earn as much as you can. You're going to continue developing your potential to create more value so that you can have more dollars flow into your life in exchange for that. You're going to increase your economic income into your life. And if you're not here, you want as much of that to be handled by the death benefit as possible. And so this is an epiphany that Lucas and I had early on, but even more so after my near death experience that happened about 5.5 years ago when I had just delivered our second daughter, and Lucas was having to hold an hours old baby girl, well, minutes old baby girl in his arms, seriously having to contemplate, because of the news the doctors were bringing to him, the potential that I might not make it. And he might have to raise two kids on his own. And because of that gravity of the situation, I think it aged our mindsets beyond our actual years. And when I say that, it's a blessing. It's something I would never wish anyone to go through, but it's tremendously a blessing to be at this age of my life and identifying so much, Bruce, with what you say of people who are in their 60s and 70s who say, I don't want to lose the benefit, the death benefit. I value it tremendously because Lucas was facing the potential of saying, okay, well, at least I would have the death benefit. And at least because of that, I wouldn't have to go work tomorrow and figure out how to get this newborn baby girl into daycare. I would be able to give myself some time. And so I think there's a tremendous benefit to making sure you have as much life insurance as you can get. Bruce, I have a question that we have not addressed.
Okay.
What if, and maybe we should have done this upfront, but, and I know we're at the top of our hour as well, so we need to wrap this quickly, but Bruce, what if you are in a position with minor children, no trust yet? Can you literally list your children's names on the beneficiary list if they're under age 18? And what happens if the children are minors and you pass away? Around that idea.
You can list them, but legally they're not allowed to get the death benefit. So it will still go through a court appointed trustee at that time to actually set up into a trust company again that will then distribute the money accordingly for a minor, because a minor cannot have access to that particular account.
I knew that. So basically, you're saying if you list your minors and you pass away with minor children listed in the beneficiary column and they are living at the time of your passing, what you're saying is probate is going to establish the trust.
Yeah, absolutely, it's going to
Okay.
establish. Yeah.
Okay. Okay.
Well, you wouldn't call it a trust, but they're
hmm.
going to establish how the money is going to be distributed, and they're going to assign somebody as a trustee of that or executor of that money.
Okay.
It could be a relative, because obviously if you don't have a trust set up, you think, oh well, my sister will just take my kids. The court doesn't always think that way, and they have to become legal guardians of those kids. So
Which
have to go through a process. So
which I'll say for anyone with minor children, please go do an estate plan. You need to have this set up so that you can decide who would be guardians of your children, who would be your trustee, how your capital, whatever you have, even if you think you don't have enough money to set up an estate plan, you need to have an estate plan, especially with minor children, so that you can be able to make those determinations. One other question, would it be fair to say if you do have minor children, you don't want to list and you don't want to list them as beneficiaries, could you and that you don't have a trust yet, could you list the person as beneficiary that you would want to be able to manage the capital on behalf of your children?
you can, but once again, there's a reason why they use the word trust. So you can list them that, but they are under no legal obligation to be the good custodian to the children.
Got it.
So
Fair
money
enough.
does funny things to people. It's I often use this analogy. A lot of people ask people to marry them, and they believe that they know that person, and that person says no to them. I'm not marrying you, even though they're blinded by that particular love. Then they think, oh, the person surely wants to marry me. I'm going to ask them to marry me. Well, the person that you trust and you think, oh, well, my sister or my cousin or my brother or whatever will actually do what I want, they're under no legal obligation to do that. None whatsoever. So you might talk to your sister and say, hey, I just want to let you know we're going to leave the death benefit to you. Please use it to raise our kids and take it through college, take them through college and so on and so forth. If you don't have a trust set up and they're not the trustee, they're under no legal obligation to do that.
Man, that is something I never actually considered the full ramifications of that before. So I think that was really, really helpful. Again, I'm not seeing the chat. There could be other questions. If there's questions as you're listening to this episode after the fact, maybe it's a month later, or you see that the timestamp on this particular episode is 5 years ago because now we're in 2030 or something crazy like that. go ahead and put your questions on the comments section because we would love to be able to answer your questions. We've covered a lot of ground today, and this was a really very fascinating episode. And I hope that as you've listened, that it has provided insight and just even enlightenment to the value of the death benefit, the value of setting up life insurance, the value of having a high death benefit, and the value of communicating that you have a death benefit and how you would desire it to be used. And there's so many steps and implications of all of those things. But thank you for listening today. Thanks for being with us on this journey with the Money Advantage podcast. And Bruce mentioned this before, for anyone who's listening, if you have questions about a current policy you have in force, you have questions about how to more effectively communicate multi-generational wealth, you have questions about anything to do with life insurance, infinite banking, money whatsoever, and putting yourself in a position of financial control so that you can build independence, we would love to be part of your conversation. So you can go to themoneyadvantage.com, you can book a call with our advisor team, and we would love to be part of the conversation of leading you through an understanding process to be able to take full control of your financial capital and maximizing everything that you have. So with that being said, Bruce, anything before I close this out? All right. Well, in closing, please remember success leaves clues. So model the successful few, not the crowd, and build a life and business you love. We'll see you next time.